One of the themes of 2025, at least so far, that I've been paying attention to, because I like paying attention to things that don't work, has been the UK high street, very roughly. And we can include in that UK retail and some other things. Like, I don't know if you want to count Greggs as retail or count it as restaurant or whatever. They appear on high streets. And you can lump JD Wetherspoons in there as well. This has generally been a very weak sector over the last 6 months or so, perhaps a bit more than that. But I saw something this week, actually, which I should have seen before, that just started to give me some encouraging signs. So here's a bit of background for the moment for those that don't necessarily follow the show in quite the enthusiastic detail with which we record it. It's been tough on the high street lately, and we've talked about quite a few stocks in their most recent things that have been posting quite weak metrics and weak results. And those results have sometimes looked better than they are because you've looked at total revenues or something and found that they're up. But they're only up because this place is opening more outlets, and they're actually growing a lot less slowly than they're opening these things. And there's all kinds of problems with that. One is that you can't keep opening things forever. And the other is that it's expensive to keep opening things one way or another. So we pay attention to, or I've been encouraging people to pay attention to a thing called like-for-like sales. And everyone seems to hate this metric. But what it does is measure your growth adjusted for the number of new outlets you open. So it tells you basically what each store on average has been doing compared to the quarter previous. And some of these numbers have been pretty darn ugly. So Associated British Foods, and by that I mean Primark, which isn't all of Associated British Foods, but it is the kind of retail-y bit of it. In their Q1 report, they reported down 6% growth in like-for-like sales. And the year before that, so Q1 2024, they were up 2.1%. So that's got much worse. That stock has been hammered recently. Greggs reported 2.5% like-for-like sales growth, which isn't bad, but it was 5.5% growth a year before that. That's actually a Q4 number, so that's coming into December rather than coming into sort of March, but I haven't heard a more recent one yet. WH Smith, the high street bit of it anyway, which they've now got rid of, for sort of half-year numbers, they were down 7%, only in their high street business, by the way. Their travel business is different for two reasons. One, it's not terrible, and two, it doesn't really reflect the UK high street in the same way, stuff in airports and hospitals and so on. But that was previously losing at 3%, it's now losing at 7%, so that's got worse as well. And JD Sports, which we don't really talk a lot about, but the stock went down a lot, and everyone seemed to think it was a buy. I didn't really understand why. It's because their like-for-like sales were down 1.4%, whereas in the previous thing they were up 3.8%. Again, that's a Q4 number. But okay, so generally speaking, rubbish like-for-like comps. People are managing to sell less out of their stores. In some cases, they've been managing to smooth this over in the short term by opening more of the things, but you can't go on like that indefinitely. However, a couple of positive signs recently. B&M European Value, I noticed, released released a full year thing, but as we say with these full year things, what we're really paying attention to, the kind of new bit, is Q4, because you already knew 75% of this thing if you were following the stock since the beginning of the year. So their stock has climbed about 30% since they brought this out in April. Still well below where it was before, but it's had a big climb since the middle of April. I thought overall their sales were up 3.7%, again mostly due to opening stuff. B&M UK, which is 80% of their business, like-for-like sales were down 3.6%. For the year. In Q4, they were only down 2.8%. Now, I think 2.8% decline in like-for-like sales is terrible. But as they say at an orgy in Norwich, it's the relatives that are important here. And relatively speaking, that is an improvement on from where they were before, which was losing at about, just nearly 4% or so. So signs of encouragement, at least in terms of decline, slowing here. And when you get to that stock, there's still a pretty big dividend. It's around 9% or so. Split 50-50, base versus special, but I wouldn't pay too much attention to that thought. The dividend all counts. And they're planning on pushing that forward. The other interesting one is JD Wetherspoon, which was earlier this week. That stock was up 1% on news of like-for-like sales growth of 5.6%, which I thought that was kind of decent, to be honest. Like-for-likes of 5.6 in this kind of environment. Everything seems to be going backwards. This is a company who their kind of headline sales growth was lower because they've closed net 5 pubs. They've closed 7 and opened 2, I think. So their overall revenue growth is slightly below that 5.6%, but Closing stores means they're pulling out costs, or closing pubs, sorry, in this case, means they're pulling out costs. And this is a company with 60 million in costs to try and find. So 7 closures will help. Revenues being up 5%, pretty much flat in total. That'll help. That's about 80 or so, 100 million in sales. You're going to lose a lot of that to margin at Spoons, but that will be handy in there. They bought a load of freeholds. That should also help bring down some costs in terms of lease expiry things. And one thing I noticed they haven't done or haven't announced is any major price increases, at least not yet. We're still not far out of the April taking effect new pricing regime thing. But they said the weather was very helpful in the last quarter, and they have bought back year to date, and they consider this to be Q3, by the way, so this is over 9 months, not 4 months. About 7.2 million of their shares. That's just under, it's about 5.75% of their outstanding share count. That's actually quite a big buyback that they've been getting on with quietly. There, add to that a 1.4% dividend or whatever it is at the moment, and you start getting to some half sensible numbers. They bought these stock back at £5.76. The stock's now at £7.30. That's 2 results now that I think have been relatively encouraging. In the case of Spoons, I think it's actually outright good. In the case of B&M, I think it's fractionally less terrible than it has been before. And so I wonder whether all the people who have been making noises about this and saying these are all great and the market's irrational and stuff's going up and the stock's going down, whether their time might be coming here, Steve. I've been wary about catching falling knives with these because your like-for-like sales can keep going down for as long as they damn well like. But I wonder whether we're going to see something turning around in the next couple of quarters here.
Yeah, Steve, I think I'm with you there. So look, I think there's 2 problems really. Is that we spend a lot of time, especially when there's something like the news of the Reeves National Insurance increases. When they come out, we it's always very difficult to understand exactly how that's going to happen, especially in the sort of speed of time that we need to react to them. And what tends to happen is everybody just puts out the absolute worst case scenario that's going to happen, and we end up reading a lot of bad news. And whether you like it or not, you can be the most aware. Of investor psychology and your own psychology. You can be the most aware person on the planet. You'll still be affected by these things going forward. And what we've seen, Steve, is we've been presented the worst case scenario as fact, and it's not really been there. It's kind of like looking at guidance, and you've got you've got the low of the guidance, you've got the high of the guidance, and you've got pretty much somewhere along the midpoint. We were presented the high case. And what's really happened here is hitting the midpoint, and we're seeing that across a lot of retailers. And like you said, B&M's their report it wasn't that bad. Midpoint profit of about £615 million isn't too bad. It's definitely fell a lot, probably overcooked the fall, and that's why you've had some of the gain. I think it's lost about 30%, even when you include the run back. So it definitely overcooked that fall, and I think potentially, Steve, you're seeing the same thing in Wetherspoons. If you read the analyst notes on Wetherspoons, they're divided over whether for 2 things really, over whether Wetherspoons will pass on the costs to customers, and some analysts are debating whether they even can pass on costs to customers. And I would say, Steve, they have to. They're going to have to pass on these costs, because at the moment they want to carry on hiring. They cannot, I don't think, absorb these costs and just become a company that churns out lower profitability. So I would assume, if I was an investor in Wetherspoons, which I'm not, admittedly, that they're going to have to pass at least some of that cost on to customers. Now they're going to be rested of a couple of things. Is that their customers are probably quite price sensitive, so they can't just rack this bar bill up quickly, because people will just switch to drinking at home. Which, if you listen to any of Tim Martin's rants in any of his annual reports, the supermarkets are kind of geared to beat him in a way that's kind of sad for business when you actually read it and try and be neutral about it. It's fairly sad for business that he is he's in a, well, not just him. All pubs are in a tougher situation when it comes to providing beer to patrons essentially. So yeah, I think he won't switch to this lower margin kind of business. I think he might drip this price increase through over a period of time, though. So maybe some short term hits to profitability, Steve, which is potentially being priced in by the market. They're the falls that you've been seeing recently in the stock. But long term, when he starts to push these prices through, he will learn slowly what his patrons can bear. And JD Wetherspoon has the balance sheet and the business and the name to be able to push these cost increases through. And your little mom and pop pubs, they're going to have a harder time of it. They're going to have to get this right quickly, whereas Wetherspoons don't. So yeah, I expect that they'll probably do okay out of this, Steve. I've been perennially worried about pubs going forward. I'm not so worried about other shops because I think shops like for instance something like JD Sports, they're going to be able to pass through the costs because they have to. There isn't really an option to it. The £40 trainer becomes a £50 trainer. Well, then so be it. That's just what happens. The difference is, I just don't think you can do that with lower priced products like pints. So we'll have to see, Steve. But yeah, look, it's another one of those stocks that I said the same thing last week. It's not a stock I would own. It's probably not a stock I would research, but I'm glad we are covering it, and I'm glad that we've got it in things like the BritBox and things like that. I think it's in the BritBox, because I get to learn about how they approach these things and what they do moving forward. So yeah, really looking forward to seeing what happens, Steve.
I'm glad you're glad because I own it and plan to keep doing so. There's something I pay probably too much attention to with JD Wetherspoon, which is a thing called the RSM Hospitality Tracker, which basically measures like-for-like sales across a whole bunch of different businesses in the hospitality industry. It does not include JD Wetherspoon. Don't know why. It includes most of the other kind of major pub names. And what they've been kind of charting for the last quite a while now, certainly since the last budget, where you might say is kind of the most relevant starting point, is hospitality in general has not done great. But different parts of hospitality, if you take a sort of fine-grained approach to these things, have fared better and worse than each other. Pubs have generally done okay. Their like-for-like comp was 3.6% higher in March. I suspect Spoons was a bit better than that if it was 5.6 for the quarter. But generally speaking, 3.6 like-for-like is okay. At the right price, you can live with that. It's ahead of inflation, but not by a huge amount. But it is up. Restaurants were not in good shape, and bars are getting hit the worst of them. Bars are going backwards at an absolute rate here, and they're perhaps a decent example of the kind of thing you're looking at here, Stephen. I sort of wonder. I don't know whether there's trading down into pubs per se, or whether people who go to bars just don't like pubs that much and won't trade down and will therefore stay away entirely. But from what I'm seeing from that, I think the recent kind of moves have been very much different across the hospitality space, which makes me interested, at least in this. And I don't know how well that jives with my own experience of these things. I don't think I've been in any of these hospitality venues kind of that recently. But I'm interested in that thought going on. And to some extent, my view of Wetherspoons always has been, if this is worth owning, and I think it probably is, it's because it's an unusually good business in an unusually unpromising area. It's a bit like Ryanair, and I got them from the same person, the two ideas from the same person of, look, ordinarily I wouldn't touch an airline particularly, but this is a clearly differentiated thing, and it could probably do well, even though the sector as a whole is one that I really dislike. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.